Hello and welcome to Unleashed, the show that explores how to thrive as an independent professional. Unleashed is produced by Umbrex, and you can sign up for our weekly newsletter by going to umbrex.com/unleashed. I'm your host, Will Bachman, and I'm excited to be here today with Kyle Sturgeon, who is the managing partner at MERU, which is a turnaround and restructuring firm. Kyle, welcome to the show.
Thanks for having me, Will.
So, Kyle, what I thought we could talk about today was a couple case examples. Before we start recording, you gave me a couple. We talked about a couple that I thought would be really interesting. And then in the second half, we can talk some about your firm in particular and how you and your founders started it and how it's grown now. So maybe just give us a 1 minute, though, intro into kind of who you are, what your background was, and how you got to where you are today.
Sure, happy to do that. So my background has been in the turnaround and restructuring space. So I started out in 2006 at a firm called Alvarez and Marsal, which is now grown to be a pretty large consulting firm that serves all sorts of different needs. It originated as a boutique turnaround and restructuring firm focused on guiding companies through distress. And I was part of the restructuring practice in Atlanta, Georgia, where I live, and was there for many years. I got headhunted into McKinsey's turnaround practice, RTS, as that was getting going back in 2012. And then I left McKinsey in 2016 to start MERU, my firm, back in early 2017. And so what we do, the firm, just as the Cliff's Notes of what we do, is we assist with companies both in turnaround situations, typically private equity owned businesses that are underperforming, and help develop operating turnaround strategies, as well as with companies that are in distress and need assistance managing through liquidity issues, covenant compliance issues, and potentially going through a bankruptcy and restructuring practice.
And to give people a little bit more context on Meru, so you started it with, I think, what, three other partners, and
Yeah, it was actually just me and one other guy. So my good friend Nick Campbell and I had worked together back at Alvarez and Marsal, and had stayed close after I left. He stayed. I left to go to McKinsey. We actually had breakfast. We'd bring our kids, once a month on Saturdays. To give our wives, the extra hour to sleep in or whatever, and have breakfast at 8 a.m. on Saturday mornings. And the idea of Meru grew out of those breakfasts, believe it or not.
what's the name of the firm mean?
Yeah, the name, good question. I need to record a video on this. We get asked about it a lot. So it's actually a mountain in the Himalayas. There's a great documentary by Jimmy Chin, the same filmmaker who made Free Solo, that Nick had seen as we were talking about the idea of the firm. He begged me to see it. I was inspired. It's about three guys who try to scale the shark's fin face of this remote Himalayan mountain. They can't do it. They come back several years later and try again. It's just a really cool story. It's different. We didn't want to name the firm after ourselves, so it resonated with both of us. It was the placeholder name that never got replaced. So it's still there.
I can see the connection. So, so climbers are starved of oxygen. Your clients are starved of cash. So I see the connection. So let's talk a couple examples. So the first one is one that actually did not turn out so well, or maybe you were brought in, with the expectation that it was not going to survive. But one client you brought in to help actually shut them down, and that's something I don't think I've talked about really before. Just what's involved in actually taking a company that is going to run out of cash, and how do you do that as gracefully as possible. Talk us through that case example.
Sure. I'll give you the high level and then try to go into a couple of specifics. So the company was about a 200 million revenue women's apparel retailer. And believe it or not, we were actually brought in to help try to improve the finance function of the company. There was a belief that the forecasting process wasn't working very well. There was not great visibility into some of the operating metrics and liquidity. And so when we were hired, it was more like, hey, this company is not doing as well as we would like. And we kind of don't like the CFO. He's going to be gone. And so maybe you guys can take a look around and see if there's anybody in the business who could be the CFO, and if there's a better way to run the finance function, because it's not just, we're not getting the information that we need. We don't believe the numbers.
Kyle, I'm sorry, but I'm already laughing at this because it's like, because you told me the ending, it's like I can imagine the day when you're like, I have some
Yeah.
bad news for you.
Well, yeah. Well. So the other piece that I don't think we mentioned before we started recording, this was in February 2020 when we started having this conversation. And so we show up on the ground at the client in March 2020.
Oh God.
As maybe future listeners will hopefully not know the significance of that date, but that was obviously when the COVID-19 crisis began to hit the U.S. in full. There was an immediate flow through into sales. The company, the first day we were there looking at the sales report, it was like down 45 or 50% or something like that versus what their plan was. They were just getting absolutely annihilated. And, a week later, all the retail stores had to be closed. 2 weeks after that, the company, before they even realized what was going on, decided to cut roughly 50% of the heads of the business, and was sort of faced with a glaring need to either inject significant additional capital into the business to make it viable, or to try to gracefully wind it down. And the sponsor was not willing to put in more money, and so that left sort of one option.
So what's involved from that point? When once a company, when the owners have decided to shut it down,
Yeah.
and not going to go into bankruptcy and restructure, but just say, okay, we got to shut it down. I always wonder about those things, like who's like the last person kind of paying the bills and
Turning the lights
turning the
off.
lights off and making
Yeah.
sure that they, you know, that there's still, I don't know, accounting records, or someone has to file the taxes or something, right?
Yeah.
How did you wind it down? Can you tell us a story?
Yeah. So taking a step back, right? The company was not viable as a going concern, and so it needed to be shut down. That being said, it had a decent size ABL, asset-backed loan, with a large commercial bank that everybody would know the name of. And so the private equity firm had a relationship with that lender, and it was, they had collateral over everything. And so the first goal was, okay, how do we get these guys? How do we get the bank paid back? And also, how do we produce as much value out of all of the inventory that we have and all of the product that's on the way, and in sowing and development, in order to generate as much money as possible and pay the creditors of the business as much as possible. Unfortunately, what we learned pretty quickly was there was a tremendous amount of past due accounts payable, primarily with the apparel vendors, but also with a bunch of other creditors. And so as we're looking at it, it was just very clear that it was unlikely that everybody was going to get out whole. And so our job was basically to try to generate as much value as possible, to leave everybody, to get all the creditors paid back as much as they possibly could, with the bank coming first because they have first priority lien on all the assets. And so that was sort of we knew what the endpoint needed to look like, and then we had to map out between, okay, here's where we're at now. We have all these heads, a lot of people's jobs don't necessarily make sense anymore. If we know we're not a going concern, right? We don't need to design for the winter season if the company isn't going to be around in the winter. The marketing team doesn't need to be the same size and scope that it is if the business is going to shrink. The retail team, there were retail stores, right, and the management structure set up around that doesn't need to exist. So there was all these sort of micro decisions that started getting made in the way in order to skinny down the cost structure as much as possible, such that all the cash that was being generated from selling off the inventory could be used to pay back the bank, and then ultimately as much cash as possible being used for other creditors as well.
And then, I mean, how did you manage to sell the inventory of clothes? Was it just
Yeah,
pushing it through all online, or like how do you get it out the
yeah.
door?
So it's a great question. So fortunately, the business had a large presence, a direct presence, branded online presence, as well as a catalog and call center. And that was still dramatically impacted, very negatively comping, but at least was a way to sell goods when the retail stores closed. They actually never reopened. We kind of did the math, and it didn't make sense to ever reopen them because we'd stopped paying rent, and to get the landlords to take the padlocks off would have required more than we would have generated by selling the product that was still left in the stores. So we actually packed up all the inventory that was in stores, brought it back to the distribution center, and ended up selling it through the website. And just had to be increasingly promotional in order to move product in the environment that was the kind of COVID spring, early summer of 2020.
And then how does it, a company end up winding down? I mean, most of us are used to kind of dealing with an ongoing concern, but sort
Right,
of how do you, you know, and you can imagine it building up a company, you keep hiring people, but then
right.
how do you kind of narrow it down so that you, at the end, you kind of file your taxes and then file some kind of form that says we're not going to file taxes in the future, and then just,
Yeah.
turn off the key and it's just, gone and disappeared then.
Well,
What's that
I
process?
guess the way that I would describe it, right? If you think about it, there's really two worlds, right? One world, you've got enough money to pay everybody everything that they're owed,
Mm-hmm.
and then I think to your point, it's you come up with a plan for letting everybody go and paying them what they're owed, and I think you file the final tax return. Like there is a fairly orderly dissolution process. You can dissolve the company with the Secretary of State, incorporates it. Some legal stuff that you have to do in terms of resolving everything, and you probably need to keep your records because just in case there's future litigation, there's that risk as well, right? But so that's the easy world in which there's in which there's enough money to go around. In this case, there wasn't, and it was very obvious that there wasn't going to be enough to go around. And so, really, in those circumstances, you can file a company for bankruptcy, either Chapter 11, which is used typically for companies that are going concerns. That gives you a chance to reorganize your affairs and convert debt to equity, or come up with a plan to pay back your creditors to the extent possible and in the priority order that they're owed. Chapter 7 bankruptcy is just a straight liquidation, where a liquidator is a professional appointed by the court, is appointed. He's in charge of basically paying everybody what they're owed based on the proceeds that are available. That's a federal process that can be very unpleasant because Chapter 7 trustees frequently pursue litigation against people who get paid before a company goes bankrupt, and so that can be a very unpleasant and uncontrollable process. People don't in the industry try to avoid Chapter 7 if it's possible. And then another alternative, which is the one that we use in this case, was something called an assignment for the benefit of creditors, or ABC. And that's a state legal process where effectively a trustee takes over a insolvent estate for the benefit of a creditor. In this case, it was for the benefit of the secured lender, and administers the proceeds of the estate, tries to generate as much from what's left. So for the inventory that we hadn't sold, for the intellectual property, the brand that was actually sold for quite a good amount, actually ended up being a good recovery for some of the unsecured creditors as a result, to somebody who was looking to get into apparel, consumer apparel, wanted the brand to keep going. and then they'll take care of the taxes. So there's other firms that do this assignment for the benefit of creditors process. So that's ultimately the route that the board of directors for this company ended up choosing. It's much lower cost than bankruptcy, and can just be a better result for creditors as a result.
So assignment for the benefit of credit. So in that earlier one, I think the chapter 7, you said that can be ugly
Yeah.
because it's people that got paid before you declare bankruptcy. They can kind of go after them and says, "Oh, you shouldn't
Sometimes,
have."
yeah. What's called a preferential transfer. The whole point of bankruptcy is to treat everybody fairly. And
Mm-hmm.
so if you're going bankrupt and you pay all your friends, and you don't pay all your enemies,
Right.
the trustee can come and try to make things right. It says, hey, instead of you getting 100 cents and somebody else getting 0, I'm going to take back that 100 and give you both 50 cents because that's what should have happened. That being said, that can be that can be a very aggressive process, and a lot of things that we're really, hey, we're paying because we need this inventory, right? We're trying to generate as much cash as we can. It's better for us to sell the inventory through our website than to sell it to a liquidator. Liquidator pays 10 cents on the dollar of cost. We can get $2 on the dollar because we're still selling it as if it's branded merchandise. Things like that are ordinary course business decisions can get questioned, and it becomes an expensive and a process that you'll lose control over, and so people don't like it.
Mm-hmm. So, and then I suppose at some point, people, I mean, as a consulting firm, how do consulting firms in these kinds of situations, and I suppose it's similar to just turnarounds where the company is troubled but may get back on its feet.
Yeah.
Do turnaround firms typically require payment in advance, or because
How does your business model work, Kyle?
yeah,
Is that the question that I'm hearing?
basically, yeah.
Yeah, we dealing in distress situations, right? Even for companies that are have bad balance sheets but are going to survive through a bankruptcy process. You always risk if you are owed money by a company that files bankruptcy, right? Like that amount that you were owed is at risk.
And how do turnaround firms typically get paid in that case? Do you typically get paid up front, sort of require a retainer because there's that fairly decent risk that you won't get paid otherwise? How do firms deal with that in the industry?
Yes, you hit the nail on the head. Typically, firms like ours and competitors of ours will require a retainer and basically get prepaid for the work that we do. That actually is shielded from preferential transfer recovery. So we want to end up if our client has to go through a formal insolvency process like a bankruptcy, we want to end up owing them money, right, where we've been paid for more work than we've done, as opposed to the other way around. Because if we are owed money, that money is at risk if we want to continue to serve the company once it's in bankruptcy.
So you structure it such that the payments to you would be shielded from this kind of Chapter
That's
7
right.
clawback process.
That's right.
Yeah.
That's right. And to be clear, the clawback process exists in Chapter 11 as well, but it's just typically it's something that is something everybody knows about and negotiates as part of the overall restructuring, because a lot of the creditors are similarly situated and don't want to get sued either, and so it's just more controllable when it's not in the purview of a Chapter 7 trustee.
So to avoid the Chapter 7, let's say that the company does not have enough funds to pay everyone 100 cents on the dollar.
Yeah.
Do you then try to get people just to agree to accept something less, and then if everybody agrees, you can avoid doing that?
Yeah, that's definitely a possible way of doing that, right? The challenge is you have a holdout problem. So if a company has a large number of creditors, you need basically unanimous agreement, because if you don't get it, somebody can say, no, I don't have to agree to this, right? I'm not going to agree to it, and sue you for the money. And if you don't have the money to pay them, that becomes a problem. And so that's that's typically the reason why you see bankruptcy used to restructure liabilities, is to solve for folks just holding out for where, from a collective action problem, it may be better for the collective for everybody to agree to something less than what they're owed, but without a mechanism to enforce it, you kind of you need that hammer, which is the bankruptcy process, to enforce it.
Okay. Well, let's talk through another example, one that turned out a little bit with a rosier outcome. Talk to me about a kind of restructuring project, a turnaround project that where they exited and they're now a going concern.
Yeah, those are the ones that we prefer. So another interesting project that we did was for a company called Tough Mudder. It's a company that puts on obstacle course races. Actually, and I know they probably there's probably some debate about the origin of this. They're the first well-known company doing this in the United States, right? These races, they're 10 miles long. You go and you climb over a wall, and you go through a freezing ice bath and stuff like that, and get a medal and a beer at the end. I don't know, Will, have you ever run a Tough Mudder or a Spartan race?
I have not. I suppose short sections of my life may have felt that way, but I've not done one of those. I've heard about it though, and I've also heard that these are very much about people like help each other out, finishing the race,
Right.
and there's like this whole community thing around
That's
it.
right.
So I've definitely heard of this company. I didn't know that they had gone through this financial trouble, but you hear that they're quite popular, and they were like exploding in popularity
Right.
for a while. So tell us the story.
Yeah, it's an interesting story. So Tough Mudder was started by a guy from England, and his old school friend, Will Dean is the primary founder. He was Harvard MBA, very interesting guy. Started this business. They put Facebook ads out for a race, and it sold out in 2 days or something like that. And they made a ton of money off the first race, and they realized, hey, this may actually be a business. And so it went from one race in rural Vermont to $100 million revenue company in something like 2 years. So just scaled incredibly quickly, was very profitable, and it was a bit of a fad. And so I think a lot of people just want to say, hey, I've run this once, and that's enough, right? And so once they worked through all that, they started to see sales decline. Another thing that happened was they were started in I'm going to get the year wrong, 2010 or thereabouts, really the infancy of Facebook advertising, when Facebook advertising was incredibly inexpensive. It was a fraction of the size it is now. And so they were able to acquire customers incredibly efficiently. And over time, that became much more difficult. Also, there was a ton of competitors that entered the space as well. Spartan Race started about the same time, but there were a number of other companies that were all basically trying to do their flavor of the same thing. And so the company began to burn cash. And when we got involved, it was actually right on the brink of running out of cash. And one of their creditors had agreed to put more money in, but contingent upon getting a change in the kind of executive leadership function, and getting getting a turnaround person basically to oversee the turnaround. And so that's sort of when we got involved.
And walk me through the story. So what do you kind of do first when you start one of these engagements?
Yeah, great question. So the first thing that turnaround folks do is understand liquidity. So when we got involved, there had already been an agreement to put in some more money. There was an understanding that the company needed more money in order to be able to continue to operate, and so there was an agreement to put in some more money. We wanted to understand very quickly, and I think within 2-3 weeks, had a decent 6-month outlook to say, here's what you've agreed to put in. Here's how much more we think is needed. just to understand, so we had a full runway of uh, what additional money was going to need to come in to make the turnaround successful.
And how do you
So that
do
was sort of
that? Is
the
that
first stage.
um, um is do you go through an exercise almost sort of week by week cash
Yep.
forecasting, or day
Yeah.
by day, or what's the process, at the very tactical level that you're doing?
Yeah. Sure. Yeah. There's a tool that turnaround folks all know and love called the 13-week cash flow forecast. It's typically 13 weeks long because that tracks with a company's fiscal quarter. But there's no magic to that. 13 weeks can be longer or shorter. We typically do at least 26 just to have a little bit longer view, but it's a very granular view of a company's cash forecast. A lot of companies will only forecast at the call it cash flow statement level, which is an indirect cash flow forecast. This is a direct cash flow forecast where you show receipts on the top and then disbursements in different categories like payroll and rent and marketing dollars underneath on a week by week basis. So it's kind of like how you might think about your own checkbook, right? Dollars coming in, dollars going out. What does the ultimate liquidity at the bottom look like? And shows, hey, we've got an interest payment coming up at the end of this month, and so we need to make sure that we have the liquidity to make that, things like that.
And then are you doing things like looking immediately for immediate cash savings, uh, either layoffs or getting out of
Yep.
contracts or closing things down, shutting down real estate, shutting off advertising, whatever?
Yeah. So there were a couple of things that we had that we did. So one, once we had a handle on liquidity, uh, we also had a built a decent full year budget, so we understood kind of what the overall trajectory of the business was, and had a sense of where it had been, and identified some gaps kind of right from the start. So part of that was on overhead. We just couldn't afford the overhead structure that the company had. Right, it had skinny down somewhat, but there was still a lot of the legacy overhead from a bigger company that because it had shrunk, and it's particularly shrunk, holding the same number of races but having half number of people attend, is the races themselves are basically fixed costs, right? You pay to construct a course, and then each racer that runs over it is 90% incremental margin, right? You buy them a beer, you give them a T-shirt, and that's basically it. So it didn't. We had to evaluate the fixed cost structure in light of the fact that a lot of the challenge of the business is they're trying to run the same number of races with a lot fewer racers running over them, and it just wasn't nearly as profitable anymore. So understand the overhead costs, head count, other kind of overhead support. Looked very carefully at marketing. Like I mentioned, Facebook had ballooned in terms of total cost, and so we realized that we had to get the cost of acquiring a racer down significantly for the business to make economic sense. And so there were a number of specific initiatives, turning up emails, and getting more efficient out of email marketing, for instance, being smarter about how we were spending our digital marketing dollars. We realized we were paying for, just to use an example, this is actually a funny story. So historically, the company had paid for their own name on Google, right? They bought any search related to Tough Mudder. If somebody searches Tough Mudder, the first thing that comes up is a paid ad for, hey, race on Tough Mudder. They actually had stopped paying Google, and so got turned off by Google Ads because they were out of money before we got involved. And they realized that when that happened, their organic traffic spiked, and so they were spending all this money on buying branded search where they were going to get the traffic anyway. So don't pay Google if you're going to get it. So it was making smarter decisions like that to let you get your cost per racer come down, and just have better flow through economics on the races.
And would your firm be kind of the ones getting in there and driving those projects? I mean, that sounds like a classic kind of management consulting project. How can we optimize, customer acquisition cost? So, would someone from your team be like leading those kind of initiatives?
We were involved. I would say for this one, it was a smaller team, and so just a lot of the companies that we work on are not, the giant, when I was at McKinsey, the giant 10 billion, 20 billion revenue companies, right? So for us to dedicate a full team to those projects, sometimes it doesn't scale. And so I would say for that one, that was actually we were supporting the work that the marketing team was leading, and helping them to execute on all of those initiatives. But that is something we have subject matter experts at the firm that we can get into the weeds, elbow deep into those type of marketing and sales efforts when kind of the engagement scope warrants.
How does a turnaround consultant think differently about companies than your typical management consultant? So the RTS folks at McKinsey, how are they think
Yeah,
differently than your average McKinsey consultant?
yeah, great question. I'd say that probably the first and largest way is just an orientation towards cash as opposed to towards profitability. I think that's born out of the recognition that cash is the lifeblood of the business. Without cash, we can't do anything. So that's why we always start with understanding what the liquidity runway looks like, right? Like that's something that in a lot of in my experience at McKinsey, right, a lot of management consultants never even really think about the balance sheet, right? They don't think about how much liquidity do we have? Do we have the ability to refinance the next maturity? Things like that, right? It's just not a problem that are ever confronted. And so we're always thinking about cash, about thinking about how the balance sheet can constrict a company. Another example is take a capital intensive business, right? They have, without cash, they may have much older equipment, and so be losing out on revenue and margin to better funded competitors because they just don't have the money to invest in their product. Or another example, we're working for a retailer, retail entertainment retailer, and if they don't invest in their in creating newness and freshness in their locations, they're going to lose out to their competitors who are doing that. So I think we're keenly aware of how important cash is, and how access to cash can be a huge constraint in turnaround situations.
Yeah. And so how does that kind of belief and key focus inform other kinds of decisions or things that you're looking at or actions that you're taking?
Yeah, I'd say one thing is that we tend to be probably more near-term oriented as a result than maybe your typical management consultant would. We tend to look for extremely fast, cash on cash payback, and be skeptical of large cash investments that don't have a clear return profile that makes sense. And so you just end up being more near term oriented, for better or for worse, right? Like there's you can point to some company like Amazon where they say they've been plowing all their earnings back into the product, and that paid off enormously over time as they were able to do that. It was a flywheel that created the company the size it is today. It's now enormously profitable after being marginally profitable or unprofitable for years. They had the capital to be able to do that. They had the support of the capital markets. A lot of our clients have other constraints on their capital that don't let them do that, and so they have to be more near-term oriented in terms of how they're managing their cash.
You've shared a couple examples from Tough Mudder. What are some other examples, perhaps from other clients you've served, of that kind of quick cash on cash payback of, tell me some stories about things that you've uncovered over the years that, were able to quickly free up cash for a business?
Yeah, I mean there's the fastest lever probably for any company that's looking for cash is accounts payable. Basically, working capital generally, right? Accounts payable, accounts receivable, inventory. That's typically where we'll look first. AP is easy, right? Because you can, it's completely within your control. And it's amazing. Sometimes you'll find companies that are very, very cash constrained, and you look and you say, well, why are you paying, everybody, you know, 15 days early, right? Like, take advantage of your full payment terms, or when's the last time we've negotiated payment terms? You'll often find that procurement folks are the ones who are negotiating payment terms. They have cozy relationship with the supplier, get taken golfing or whatever, and they may also be incented to prioritize getting the last cent out of product cost, and they're giving away payment terms as well. So there's a lot that you can do in terms of the AP side of things, whether it's negotiating longer payment terms, batching your payments, just paying less frequently, or paying at the end of every week. There's a lot that you can get kind of quickly out of AP. Similarly on AR, and we've done a bunch of engagements like this where you look at why is AR accounts receivable high? Can we get money out of AR? Can we collect faster? And even small process changes where you pick up a few days of accounts receivable can result in meaningful immediate cash recovery, right? Even just saying, hey, we're saying net 30 days, but the invoice date isn't the same as when they actually made the order. So we're just going to change that from a system perspective. And that causes the invoice to fall due 3-4 days earlier than it would be, can produce amazingly material cash returns in 30-45 days.
What are some other tips around accounts receivable, things that can help just with getting in the payments a few days earlier?
Yeah, I mean, it's one of the other things we'll do is look at the collection function and see how good the metrics are, especially for less mature companies, right? I remember one of our favorite stories going to go in and say, how many calls have you guys made today? Like, where's your call log? And it's like, oh yeah, we've got 4 collectors. They made 6 calls yesterday. Okay, that doesn't feel like we're getting everything we could out of this group, right? And so there's some just putting some rigor in process management around what that that function, how they operate, what kind of metrics they use, who they're calling, right? Are they calling the people who owe you $100 but not calling the people that owe you $100,000? So really putting rigor around the collection function. Let's see what else. Looking at the way that kind of when you set up a new customer or when you renew a customer, how you give them credit, how you give them payment terms. Does that make sense? That's another lever as well.
Yeah, I mean, on the accounts receivable, just in my own experience, I've learned through hard experience. Sometimes there's things that you can do to accelerate it, like mistakes you can avoid. Like if the client requires having a PO number on the invoice, like make sure you have the PO number on there.
Right.
And on the very day one, when you start the project or the work, ask for a PO number. Don't wait until like you're about to send the invoice and then ask for it. Put a unique invoice number on there. Make sure it's going to the right person. Make sure that it has the right address on there so they don't kick it back for some silly reason. And make sure that you've set up payment ahead of time. Those sorts of things if it's a new client. So
Yep.
in terms of
That's right.
yeah. So outside of accounts payable and accounts receivable, what are some other kind of common go-to places where you're able to free up cash?
Yeah. So another one, inventory is a little bit more complicated because there tend to be bigger picture supply chain issues. But one thing is just looking at, your excess inventory, excess age inventory. Is there stuff that we can either sell to existing customers, offer them a discount because it's been sitting around for 90, 120, 1 year, 2 years, old inventory? Can we just turn that into cash? It's just sitting on the floor collecting dust and frankly risking obsolescence if we don't move it. Looking at stocking levels on inventory as well, and that again tends to be kind of very integrated into the S&OP function and into supply chain. But making sure that when we're carrying inventory, it's the right we're thinking carefully about how much we're carrying and not just carrying more um, because some old rule of thumb, or we're having a rigorous process for deciding that kind of stuff. Um, we have a whole playbook that goes through all these these working capital levers that we use for most of our companies, as you might expect.
Let's transition and talk a little bit about your firm. So we touched on in the beginning of the show. So you started with a friend and one other co-founder. Tell me about the growth of it. To I think today you have something like 20 or so employees. Tell me about how you've grown over time and about how that experience has been like.
Yeah, it's bumpy, but really fulfilling, I would say. So we started in January 2017. Myself and my co-founder Nick, in a two-person WeWork office in Atlanta, and I think we hired our first employee in June, so about 6 months into it. We actually originally thought that we might try to make the business work without really without a full staff, and just by leveraging independent consultants. And I think what we realized was that was just going to be difficult to scale. And we really wanted to create a firm. We weren't trying to just keep ourselves utilized. I think we thought we could do that, but we really had the vision of creating a firm, right? The whole reason we started it, stepping back into, call it, the 2016, right, the year before, we both really valued a lot of the experiences we had at McKinsey and A&M, but we saw kind of things that each firm did that we didn't like, or that we thought could be done differently, done better. I think we saw it, hey, the way that McKinsey brings expertise into turnaround situations is really differentiated, right? Like that's something that's really powerful, and I got to witness firsthand the powerful of expertise, and that was something a lot of turnaround firms weren't bringing in terms of really deep functional and industry experts. But their ability to do that for companies that were below kind of the gigantic company level was pretty limited. A&M was really focusing very heavily on advising large bankruptcies as opposed to the core kind of turning companies around. That's really why we both got into the business. And so we wanted to create a firm that focused on those things. So we realized that to really scale that vision, we needed to take the step of hiring our own people, so we could guarantee their availability and invest in training and developing them in the way that we wanted them to learn the business. And so we started hiring back in probably June, July of 2017. We didn't pay ourselves for, I think, 9 months after we started the firm. So that was a bit of a fun process, but that gave us the balance sheet to feel like we could actually invest in people. We'd had got a couple of projects under our belt. I actually brought some work with me from McKinsey that helped us get started, and then we were sort of off to the races at that point.
What have you been doing to create a culture that is perhaps distinctive from the firms that you'd worked at Alvarez and Marsal and McKinsey? So I'm sure a lot of things are similar, but what have you aimed
Yeah.
at intentionally to make different from those firms?
Yeah, so the first thing that we did when we had the idea to create the firm before we left was really agree on the core values of the firm, what those would be. You can find those on our website. It's something that every employee that starts here, we spend an hour with them their first week at the firm, going through those core values in detail and explaining kind of what we really mean, why they're important to us, and what that means in terms of what we expect from our people. But those core values are working with the best, striving for excellence, aligning with our clients, and collaboration. And I think we took each of those from things that we saw that worked really well at our prior firms, but we felt like that combination of things was going to be what differentiated us in terms of the specific work that we were going to do, the specific market that we were going after. And so I guess to circle back on your question. So I think it started with agreeing on what those core values were, making sure that everybody understood those, talking about them all the time, and talking about them as a group, holding ourselves accountable to them, calling out when we saw things that we are these consistent with our core values? Are they congruent? And then over time, it's meant evolving those core values into more specific and detailed elements of our culture that we've actually taken the time to put on paper as well in the last few months, and just getting and talking about those things as well all the time with the team, and having them feel like this is what's different about this place, and this is what's expected of all of us as MERU colleagues.
Something that's tough for boutique firms is making that decision of when to bring on additional full-time employees. If you do that in advance of getting the work, so that
Yep.
then you're carrying that
Yep.
non-utilized folks, or do you like wait and then you're
Yep.
scrambling? How have you managed that process, as you've grown?
Yeah. The first few hires that we made were somewhat on faith, in the sense of we had some work, but we were still sort of managing the firm by our own 13-week cash flow forecast, right? We were looking at our own cash and how much. We weren't thinking about the revenue as recurring, right? It was more of just like, here's what, when this project ends, like here's what the cash flows of this project look like, and not counting on anybody to call us back. And so eventually we realized that for us to be able to grow, we needed to have capacity that we controlled. And so we did decide in summer of 2017 to hire a few folks in advance of the work, just to be able to say we had enough of a balance sheet from work that we'd done, and from us not paying ourselves anything, to be able to feel like we have a good amount of runway, and we've gotten enough traction in our core relationships with the people who were calling us about things, that we felt confident that it was going to be a good investment. We had identified some really high caliber people that we felt excited about bringing onto the team, and so it was that sort of confluence of things that led us to make that initial wave of hires. And I think since then, we've been, we try to manage to what we expect in terms of the overall firm utilization. As the firm grows, we've added 2 other partners, Tanner and Rob, who both sit out in San Francisco, and we have kind of more normalized view of kind of what we would expect from utilization and from our ability to generate business, and what that means in terms of what team we require.
And what's the sort of sales pitch been that you've used when you're recruiting? Because these are folks that are experienced consultants that have a lot of options, and to go to a small boutique firm, what does it take to attract folks to join you, and how do you convince them?
Yeah, it's tough, right? As you might expect. I think we're very passionate about the work that we do, and we think that the work that we do is really interesting, and it's not something that other folks are doing, right? These are companies that are typically smaller than your McKinsey or BCG or Bain would serve, but we're serving them oftentimes in a different way than another restructuring firm might serve them. And we like the idea and the ability to say, like, well, look, we're not just going to go and manage a bankruptcy process, right? Or work on a gigantic transformation that, you're one of 100 consultants all working on the same effort, right? We're a smaller team, but it's a highly credible, a highly capable strike force, working on interesting business problems, turning around businesses that need the help and don't have a lot of other places to go for it. and that pitch has resonated with the folks that we've managed to bring aboard. And we've been fortunate in recruiting a really high quality team. Starting with our two other partners, but at all levels, we have people from really top firms that have placed a bet on us as a firm. I think they're grateful for it. But folks from McKinsey, Partners in Performance, Ernst and Young, Accenture, Alex Partners, A&M, really high quality firms where folks have worked before, and so they're choosing to come over to us because they believe in what we're doing, and they know it's making a difference.
And on that note, for any listeners of the show who wanted to learn more about perhaps opportunities with your firm or just learn more about the work you do, where would you point them?
Sure. You can go check out our website. Huge project last year to refresh that. WeAreMERU.com. We are AREMERU.com.
And I'll include that link in the show notes. Kyle, thank you so much for joining today. This was a great discussion.
Yeah, thanks for having me, Will. It was my pleasure.